This video talks about the contents of the course Practical-Oriented Analysis of Financial Statements. This course is divided into certain segments. The first segment, Elements of Financial Statement, talks about balance sheet and P&L statements in their basic form, as well as about cash flow statement in its basic form. Moving further, the financial statements, that is profit and loss statement, balance sheet and cash flow statement, are being focused. The segment relevant to profit and loss statement basically talks about depreciation and how it affects P&L statement. The segment relevant to balance sheet talks about inventory and how it gets converted into COGS, whereas the segment relevant to cash flow statement talks about working capital, cash flow, cycle, and overall financial health. Then, in the concluding section, the three financial statements have been looked together. How do they correlate with each other? Also, there are a few points, a few concluding remarks about financial analysis. The course has been wrapped up with a quiz. Thank you. Let us begin our course with the lesson 1, in which I'll be explaining how the balance sheet and P&L statements are different from each other and what do they represent. To explain that, let me give you an example. Imagine that you have started a business. What would you do to run the business? You'll put in some of your money, as well as you'll borrow some money from the banks. And using that money, you'll buy some raw materials, as well as probably you'll purchase some machines, you'll construct a building or a shed. How would you be recording the day-to-day expenses of your company? Going on each month, you'll record what all sales you have done, what are the bills that you are paying, what are the salaries that you are paying to your staff, and difference between the sales, the bills and salaries will give you the net profit. This, in its basic form, is nothing but P&L statement. At the end of the year, imagine that you have taken a stock of what does your company owns and what does it owes. At the end of the year, you will be remaining with some finished products, as well as you will be owing some money to your suppliers, that is, who all gave you raw materials. You will be taking raw materials on credit. You still owe them money. And opposite of that is that the customers whom you have given your finished products owe you some money. So when what all you owes comes on the right side, what all you owe to others will be coming, what others owe to you, that is what you own, will be coming on the left side. As well as the building and machinery that you have purchased will be the asset of the company, as well as the raw material. But will you be remaining with all the raw materials that you have purchased at the beginning of the year? No, some of the raw material that you would be consuming in making the products. Also, the money that you have borrowed from the bank is also a liability. The money that you have put in is owner's equity. Your company owes that money to you. And with this, you can understand that your company is a separate entity vis-a-vis you. Now, having seen these two statements in their basic form, let us now have a look at the differences between the two. What does the balance sheet shows? It shows what a company owns and what does it owes. Whereas a P&L statement shows the revenue, the expenses and the profits which the company is making. Coming to the time span, the balance sheet is meant for a point of time, that is end of the year in this case, whereas the P&L statement is meant for a duration, January to December. What does the balance sheet answers? It answers the question that if I purchase this particular company, what are the assets that I am paying this company for? Whereas the P&L statement explains whether the day-to-day activities of this company are profitable or no. Coming to the sequence, P&L statement is prepared before the balance sheet. Now, having looked at the basic forms of the balance sheet and P&L statements, as well as the difference between these two, let us now compare them to the standard balance sheet and P&L statement formats. First, balance sheet. So this is a standard balance sheet that you see in the annual statements of the companies, whereas this is the basic balance sheet that we prepared while recording our expenses as well as taking stock. Left side gives assets, that is what all my company owns. Tangible assets is nothing but the buildings, the machinery that you have. Whereas the intangible assets includes the brand value as well as the goodwill that your company has. Capital work in progress is nothing but the machinery and building that are under preparation and construction. Non-current investments are the investments that your company has done, and that is an asset of the company. Long-term loans is nothing but the bonds, etc. that your company has purchased. Coming to the current assets are nothing but those assets that can be liquidated within a year. The current investments are an element of current assets. Inventories includes both raw material remaining as well as the finished products remaining. Trade receivables is nothing but what all your customers owe you. Cash and cash equivalent that are there at the bank of the company are assets. Short-term loans and other current assets are also elements of assets. Coming to the liability side, long-term borrowings, that is the money that your company has borrowed. Deferred tax liabilities is nothing but the tax that your company is supposed to pay, but it has deferred it, that is, it is planning to pay it next year or so, is also a liability. Long-term provisions, etc. These all are liabilities. Coming to short-term liabilities, it's the borrowings and similar things. Trade payables is nothing but the credit owed to suppliers. So you can understand that the balance sheet in its standard form is not much different from the basic balance sheet that we prepared in the previous slides. Let us now compare the P&L statement. So we said that P&L statement is nothing but sales, bills, salaries and net profit. Comparing it with a standard P&L statement. Sales. What are sales? Revenue from operations is nothing but sales. Other income includes what all your company has sold. This is all total revenue. Cost of material consumed is nothing but the raw material. Operating and direct expenses, changes in inventories, employee benefit expenses, financial cost, all this is nothing but expenses, bills. Difference between the two will give you the profit, and net profit is nothing but the difference between the income and the expenses. Here these two line items are slightly confusing. One is changes in inventories and second is depreciation and amortization. Probably we'll be coming back to these two line items when we go further into the course. I hope that you have understood the basic difference between the balance sheet and profit and loss statement and why do we have two different statements. Going further in the lesson 2, I'll be explaining the cash flow statement, its purpose, and I'll compare a basic cash flow statement to a standard cash flow statement the way I did in this particular lesson. Thank you.